Good afternoon, everyone, and welcome to a Nonprofit Accounting and Tax Update webcast. I'm Yulia, partner at GHJ, exclusively dedicated to the nonprofit niche, and I will be your moderator today. Joining me are my colleagues, Amy, Melanie, Liz, and Colin. Liz leads our nonprofit tax practice, and she will be our tax expert today. Melanie and Amy will be our technical experts on the accounting side. Colin, on the other hand, leads our data analytics services. Full bios are available on our website and will also be sent out to you together with the material and the recording after today's event. As we get started, I want to take a moment to acknowledge the environment we're all operating in. There's a lot of uncertainty right now, whether it's the economy or changes in federal and state regulations, tax regulations, updates, and even the increased scrutiny into how nonprofits are operating their programs. That creates a lot of anxiety in the nonprofit space, and not just for governmentally funded nonprofits, but for those that are privately funded and even for private foundations. Our goal today is not to just provide information, but really to spark the discussion on how to navigate what's ahead. Here is the plan for the next hour. We'll begin with a fireside chat on how nonprofits can use data analytics to inform their decision-making. Then we'll move into technical updates, covering the latest in accounting, standards, tax developments, compliance rules. Finally, we'll close with a panel discussion focused on the practical impact of recent federal actions and the steps that nonprofit leaders should consider taking in response. If questions come up along the way, please use the Q&A box together with your email. And if we don't get to your question during the webcast, we'll follow up with an email afterward. Before we get started, we do have our first polling question. And if you would like to receive CPE for this event, please answer all 3 polling questions as they come up, and the CPE certificate will be emailed to you after the event. And our first question is, what is the most pressing challenge your nonprofit is currently facing? So while you are answering that, I will tease up our first topic. We thought we would get started with a very current discussion on data analytics. As we think about building resilient organizations, a key area that comes up is how can we use data to drive smarter decision-making? In today's environment, the ability to extract the actionable insights from your financial and operational data really can transform the way that you plan, monitor, and communicate your impact. With that, I'll turn it over to Amy and Colin to share how nonprofit organizations can use data analytics to their benefit.
Thank you, Yulia, and good afternoon, everyone. Colin is the technical liaison between our audit and data analytic practices here at GHJ and focuses on assisting organizations to implement solutions related to business intelligence and automation. As accountants, we've traditionally been seen as stewards of financial accuracy and compliance, but in today's rapidly evolving landscape, especially in the nonprofit sector, our role is expanding. Data analytics is no longer just a nice to have. It's a critical tool that empowers organizations to make informed decisions and drive efficiency. Colin, thank you so much for joining. Can you first share with us what exactly data analytics is? We hear this phrase more and more now. How is it different than artificial intelligence?
Thanks, Amy. So this is something we hear more and more, and every day seems to be a new AI conversation or tool being brought up. So data analytics, big data, machine learning, and AI are commonly used buzzwords, and they sound like a black box, but they actually serve different purposes. So the way I like to think about data analytics is that it's a spectrum, from simple Excel formulas to integrating disparate systems that don't talk to each other. Data analytics is used to examine and interpret data for patterns, trends, risks, outliers, and present insights. AI is essentially computers simulating human intelligence, but AI can work alongside data analytics by enabling machines to learn and train on the data from the analytics to make predictions. So that said, there is utmost importance on the quality and foundation of the data. If the data is not clean, there's the adage of garbage in and garbage out. And this is even more important when analytics or AI will then be applied on that data. So, for example, if you're creating custom GPTs based off the organization's data, you could end up with wildly inaccurate responses if the underlying data is not clean. So, in short, data analytics tells you what is happening via descriptive analytics and why it happened through diagnostic analytics. And AI attempts to predict through predictive analytics what will or could happen, or even act on it automatically, along with prescriptive analytics, which can recommend what you should be doing.
Thanks, Colin. That explanation was really helpful. And you mentioned a custom GPT as an example of AI, but what are some practical applications of data analytics and automation for nonprofits?
Absolutely. So, a great starting point is to really identify where there's pain points in the organization or repetitive tasks where efficiency can be gained, or if there are areas or reports that are done daily, weekly, monthly, they're just terrible to perform manually and quite prone to error. So, one of the biggest practical applications that we're seeing is strategic plan key performance indicator or KPI tracking. So this can pinpoint key metrics that matter to management, leadership, and the board. And these can be both current KPIs or also KPIs that are not yet tracked, but could be tracked through the new tracking of data. You can monitor these KPIs through interactive dashboards that offer real time visibility into operational performance. Another practical application that we're seeing that holds a lot of weight is data visualization and business intelligence. So, this translates raw data into interactive visuals that show trends or underlying insights that don't naturally occur in areas such as grant distributions over time, donor contribution trends, multiple grants to the same organization, um, and then the next piece is automation. So this really goes beyond visuals to streamline those manual and quite time intensive processes. So the way I like to think about this is time reallocation by being able to shift focus to strategic initiatives while also future proofing the organization to any sort of workforce attrition. So, like retirements, staff turnover, and this really safeguards some institutional knowledge. Some practical examples of automation that we've seen is payroll automation. So, this is the auto generation of payroll reports, journal entries across multiple systems that previously required manual reconciliation. Department of Mental Health reporting, this can standardize and automate recurring reporting requirements for compliance or grant tracking. There's disparate system integration. So this is more kind of the right side of that spectrum noted earlier. This can connect financial, donor, operational platforms that don't naturally talk to each other. And this eliminates the need to manually pull, combine, and reconcile reports. And the last piece that we're seeing is a practical example on the automation side is data cleansing. So this can automate data extraction and formatting and reduce time spent cleaning spreadsheets, manipulating the data. Ultimately, these efforts really enable more agile decision making through consistent and reliable data.
And those are all great examples of things that could potentially help management be more efficient. Do you have any advice for our attendees on how they can get their boards on board, so to speak, with data analytics? And also, how could it potentially make board reporting easier?
Absolutely. So we're seeing a lot of boards really seeking new and more engaging ways to view organizational performance. So presenting key metrics through visuals or interactive dashboards, it really makes it easier to digest and act upon the information. And some benefits of data-driven board reporting that we've seen are board members can see real-time progress, quickly understand areas of concern or opportunities that are arising. Analytics empowers boards to ask more strategic and targeted questions, but can also do sensitivity or what if analyses. And it helps guide decisions related to resource allocation, risk assessment, and mission impact. So ultimately, data analytics provides a powerful avenue for engaging your board in shaping a more data centric organization.
Thank you so much, Colin. And for those of you on the webinar who are interested in implementing some of these initiatives, but are concerned about the cost, do keep in mind that there are funders out there that prioritize funding automation and data analytics projects. And I'll turn it back to Yulia now.
Thank you, Amy and Colin. Thank you. Lots of great takeaways here and food for thought. And just to acknowledge the responses to the first poll, not surprising, the most pressing challenge your nonprofit is currently facing is unpredictability with government funding. That was the highest rate response, with rising costs and inflationary pressures following that. So now it's time to turn to recent developments on the accounting and tax fronts. While data may help us get insights and look ahead, it's just as critical for nonprofit leaders to stay on top of the current developments in the accounting, compliance, and tax world. So Amy, we'll start with you.
So CECL has been adopted by most nonprofits now, and while additional analysis and documentation was needed, in general, there was little impact to allowances, as most significant assets for the majority of nonprofits are out of scope. And you can refer to the slide shown here for a listing of in and out of scope assets. And previously, nonprofits and other organizations recognized credit losses only when it was probable that a loss had already occurred, and that was under the legacy incurred loss model. CECL mandates a forward-looking approach, requiring organizations to estimate and recognize expected credit losses over the entire contractual life of a financial asset from its initial recognition. So this means even if a loss event hasn't happened yet, an allowance for expected losses may be required. And there is a new expected update later this year that will provide a practical expedient that allows organizations to assume that current conditions at the statement of financial position date would remain consistent throughout the forecast period. And it will also allow organizations to consider collection activity after the year end when estimating credit losses and going through that process. And next up, we have a reminder on legal accruals. So unfortunately, in today's environment, nonprofits are seeing increased legal claims. And we wanted to remind organizations to consider subsequent events when determining the need for legal accruals. If the underlying cause or event that gave rise to the legal claim occurred on or before the statement of financial position date, and new information, like let's say a settlement amount or a probable unfavorable outcome, becomes available after the statement of financial position date, but before the financial statements are issued, then if the amount is material, the financial statements should be adjusted to reflect this new information. And if a range exists and no amount within the range is a better estimate than any other, you would accrue the minimum amount in that range. And as a final reminder, legal accruals would be disclosed in the statement of functional expenses under management in general, rather than under program or fundraising. And now I will turn it over to my colleague Melanie to go over a few uniform guidance updates.
Thank you, Amy, and good afternoon, everyone. In regards to the uniform guidance update, many of you on the call probably have already heard this information. It shouldn't be new, as it was published last year, but we wanted to take a moment today to just remind everyone about what's coming. These changes really aim to simplify compliance and really improve transparency for applicants, recipients, and subrecipients. And here are just a few high-level key takeaways. First item would be the single audit threshold will increase from $750,000 to $1 million. To remind everybody on the call, currently any nonprofit organization spending more than $750,000 in federal funds has to undergo what we call a uniform guidance audit. It follows the audit requirements from the federal government. This threshold, as I mentioned, will increase to $1 million for any nonprofit with year ends after 9/30/2025. I know a lot of the nonprofits that we work with have either 6/30 or 12/31 year ends. So for you, this would be applicable for year ends 6/30/2026 and 12/31/2026. In addition, another update would be the de minimis indirect cost rate, which will increase from 10% to 15%. Please note, this is only an option if you have been previously using the de minimis cost rate. I know a lot of the nonprofits that I work with, they actually use a contracted, negotiated indirect cost rate. So in that scenario, this would not apply to you. And again, this increase in the percentage is to provide greater flexibility to any recipients of these federal funds, so really the grantees, to charge through more of the indirect costs that they typically are not able to charge through as the direct cost. Another threshold that's increasing is the capitalization threshold for equipment purchases. Currently, that threshold is at $5,000, but it will increase to $10,000. And this updated threshold is really to aim to enhance and simplify the management and tracking of these federal funds for grantees which were allocated to equipment. Then the last item noted here on the slide refers to the emphasis on cybersecurity. I think all of us on the call today can agree on that cybersecurity really has been a hot topic, really due to the nature and the environment that we live in. But the uniform guidance also now is noting this as an area on emphasis. Federal agencies and their partners are now required to what they call implement reasonable cybersecurity measures as part of the internal controls. The guidance doesn't really specify what cybersecurity framework that needs to be used. It just merely points to the fact that it needs to be practical and proportionate security measures that are aligned with industry standards as well as best practices. Now, of course, again, this could be various things, but I think when I think about cybersecurity measures, a few questions I wanted to point to would be, what does your current data protection look like? Have you implemented appropriate protection measures such as encryption, access controls, and secure transmission protocols? Also, in a situation of cybersecurity breach, what does your incident response plan look like? Can you really effectively detect, report, and potentially mitigate these security breaches? And then also, do you provide cybersecurity awareness training for the employees to educate them about common threats and best practices? Because I hate to say this, but probably 8 out of 10 times it's an internal employee that clicked on a wrong link in a very convincing email that they received that unfortunately opened up the nonprofit for a cybersecurity breach. So that was a quick high-level update on the uniform guidance updates. And now we'll turn it over to Liz for the tax update.
Great. Thank you, Melanie, and good afternoon, everyone. We'll go ahead and get started on the tax update. We will go ahead and start with proposed legislation. I do want to point out this is still in process of being passed by the Senate. It was approved by the House. It was rejected by the Senate, so there may be provisions and changes for this current bill. So none of this that I'm going through is final, but it's good to understand what's included within the bill, as there are many items there that may impact nonprofit organizations. So the first one being there's a proposed rule to increase the excise tax on investment earnings for large universities. The excise tax would go from a 1.4% up to 21% on earnings. So again, this is geared more to those larger universities with large endowments, which may not be applicable to some of you organizations joining us today. The next provision is on charitable contributions for non-itemizers. A couple of years ago, they increased the standard deduction for individuals, which meant that there were fewer individuals actually itemizing in their individual tax return. And we did see a decrease in overall charitable contributions to nonprofit organizations because of this increase in standard deduction. So they added a provision in there that would allow an above-the-line deduction of $150 for individuals or $300 if you're married. And this donation would be above the line. Even if you have the standard deduction, you would still be able to use it. Again, it's to hopefully maybe increase that charitable giving that was unfortunately decreased due to the increased standard deduction. The next provision would impact private foundations. I know this is something that a lot of our private foundation folks are worried about. So what it does, it replaces the 1.39% excise tax, and it is increased based on the total fair market value of assets held by the private foundation. So if you have $50 million of assets or less, you're still at the 1.39%. But once you go above above that, then that's when the excise tax on your net investment income would start to increase. So if you had 50 million between 250, it goes to the 2.78%. And then above 250 million, then you go to that 5%. And then it actually doubles to 10% for those very large private foundations that have over 5 billion in assets. So this is specifically for non-operating foundations. And I was having a conversation with somebody in the nonprofit space as to, would this motivate some private foundations to actually change to operating private foundations in order to avoid some of this excise tax, meaning they would need to actually undertake some of those charitable activities directly and convert to a operating foundation in order to not have to pay this excise tax. So I'm just going to see how everything turns out and what approach some of our foundations actually take. The next provision is on unrelated business income. The rules are adding new income to what's considered UBI. Unfortunately, part of that is considered a tax on transportation and fringe benefits. A few of you may recall a couple of years ago, it was added when we had a bill, and this just caused chaos, confusion. Organizations didn't know how to calculate an expense because it's initially a tax on an expense incurred for parking. And it ended up actually being repealed, and then we had to go back and file for refunds. So it was a nightmare, and I am hoping that that is ultimately removed because it's just very hard to keep track of. And then there's also, in addition to research that is not made publicly available, would also be subject to unrelated business income tax. There is a provision to expand excess compensation tax to all employees paid over $1 million. So currently there is a 21% excise tax on the first 5 employees that are paid over $1 million by a nonprofit organization. This provision would apply to any and all employees that are above that $1 million threshold. So they're just expanding it. So it's not your top 5. The next provision is on corporations. So they are adding a 1% floor to charitable deductions made by corporations. So at the moment, corporations are able to deduct 10% as charitable contributions. And then going forward, they would need to at least donate 1% of their total income in order to be able to take the deduction. And I know corporations are big funders, they're corporate sponsors. Sometimes they provide equipment, products are donated by corporations. So this also may impact some of that charitable giving made by corporations. One item that wasn't included in the bill, if some of you are aware, is the HR 9495, which was to stop terror financing and would actually revoke the exempt status by the U.S. Treasury on any organization that they established was funding or supporting a terrorist organization. So this was not included, which is very good to hear. And so we don't have to worry about that at the moment. I know there were some concerns about there because there are several organizations that provide financial aid to foreign countries. And so, would that be considered providing terrorist support? And there was just concern all around there. So please go ahead and go to the National Council for Nonprofits website. They have information regarding everything on the proposed legislation and how it impacts nonprofit organizations. They are a great resource. So please stay updated. They have something for executive orders. They have something for legislation. That is a great resource to go and keep updated. Now we'll move on to other considerations that tax-exempt organizations should be thinking about. One of them is understanding lobbying and advocacy. I think sometimes organizations are scared to undertake lobbying, but it's important to know that as 501c3 public charities, you are allowed to lobby. There is a limit, obviously, as how much you can do in terms of lobbying, especially when there's funding that is potentially at risk. I think this is the time to be out there. And so when you are lobbying, is you're attempting to influence legislation by propaganda or otherwise, you're advocating supporting or opposing legislation. If you want a clear threshold in terms of expenses and how much you can undertake, I would encourage you to make the 501h election, and that, depending on your total expenses for the year, you could then calculate how much lobbying you can incur. So it actually goes up to $1 million if your overall expenses are 17 million or more during the year. There is also the Alliance for Justice website that offers a free calculator where you could input, what you consider to be lobbying, what's indirect lobbying, what's considered advocacy versus lobbying, because obviously advocacy is different than lobbying, and you wouldn't capture those costs there. So just stay informed. Encourage you all to also visit that website. The next topic I wanted to cover was just on diversity, equity, and inclusion scholarships. We have several nonprofit organizations that tend to give out scholarships to minority groups in different areas. And so there was that executive order that did terminate all discriminatory and illegal preferences on policies, programs, and activities. And so I have seen a shift in language being used for criteria to award some of these scholarships. So it is important to remember that a charitable purpose by the IRS is to provide support to relief of the poor and distressed and the underprivileged, advance education, and promote social welfare. So when you're adding the criteria or the language, you could still use that you're providing scholarships for individuals with unusual or personal family circumstances, or students who had to overcome significant obstacles in pursuit of education. So there's still language that folks are using and changing. So if you are awarding scholarships, just look to see what is that criteria that you're using. The second item is on just resources from funders. I know most charities, when you're talking to the funder, you're looking for grants, monetary support, but a lot of funders are offering other types of assistance, such as maybe some training, education, legal counsel. So just make sure you're having those conversations with those funders to see if they are providing some of these additional resources to nonprofit organizations, as I know some of them are out there providing this. And lastly, I have seen an uptick in interest on an internal compliance check, meaning you would undertake a mock audit to make sure that all of your policies, procedures are in place, you're treating employees correctly. Again, as I think nonprofits are a little bit more scrutinized at the moment, there's more concern of potential IRS audits and procedures. I have seen an interest of just organizations trying to undergo an internal compliance check to make sure they have all the boxes checked. That is all on the tax update. I'll turn it back to you, Yulia.
Thank you, Liz. And thank you, Melanie, Amy, and Liz, for the insights into the latest updates affecting nonprofits. We're now launching our second polling question. How is your organization responding to recent federal actions, executive orders, potential changes in the proposed tax bill, and any other ones? So as you work through answering that second polling question, we'll go ahead and get started on our panel discussion. Recent federal actions and potential changes in tax legislation that Liz just went over put many nonprofits on alert. Really, financial sustainability is becoming more important than ever. Federal and state agencies are still grappling with how exactly their programs will be affected and how that will get reflected in the contracts with nonprofits. So far, we have seen contract terminations, program funding reductions, and changes in contract terms to align them to the current federal policy. And that may or may not be consistent with the mission of the nonprofit. And so in this conversation, we'll explore what nonprofit leaders should focus on as a result when planning for long-term stability. And we'll talk about some of the key financial indicators and tools that you can use to help stay on track. My first question is to Melanie. In the current climate, what best practices have you seen in thinking through financial sustainability?
Thank you, Yulia. When it comes to best practices for financial sustainability, I really think there are several key steps nonprofit can and should take, especially given today's uncertain environment. I think first and foremost, be proactive. Just recently, I had a conversation with the CFO at a nonprofit that I work with, and he did mention how they really have focused on scenario planning in recent months to really assess the potential impact of disruptions in their funding streams. When they have these meetings where they go through the scenario planning, there are several key questions that they ask. What happens if a key source of funding that we have is delayed or completely disappears? What are some of the essential cash flow needs that we have as an organization? And how can we continue delivering the service to our participants under these various conditions? And so having a plan for these multiple scenarios and quite frankly, having answers to these questions that I just went through really puts your organization in a much stronger position to respond quickly and effectively. Another best practice would be to evaluate your liquidity. I think it's not just about having the resources, the assets on your statement of financial position or your balance sheet. It's really about understanding how liquid those resources are. As an example, many nonprofits have very established investment portfolios, but how liquid are those investments? Can you really access these investments if the need arises? Really consider looking at your assets based on how quickly they can be converted into cash to really better understand your organization's financial flexibility. And then another item, while this might not be the most popular solution, really consider short-term financing options. Of course, it's not a long-term solution. However, having access to lines of credit and short-term financing tools really can provide your organizations a crucial buffer in these times of disruption. It's really worth evaluating these options now before they're urgently needed, so you can act quickly if the situation calls for it.
Yeah. And that could actually add on to that, just in terms of just the importance of donor relationship and being transparent with some of those donors and grantors is really key, I think, in the current times. So make sure that you're clearly communicating how the funds are being used, how they directly support the mission of the organization. I recently attended a session where they talked about navigating donor relationships in times of uncertainty. And I thought they made some great points. The first one being using all various communication channels, such as, your social media, your email, your newsletter, to really foster engagement with some of those donors and highlight the areas where the needs are the greatest, and also customize the messages so it resonates with the donors that are using the platform. So you may use different language when you're using Instagram versus your newsletter. So really customizing that to the readers. Provide some opportunities to those stakeholders to provide feedback, ask questions. I think when people feel heard and that you value their input, they react different to how they engage with the organization. I think especially now, funders may be more willing to provide some general operating support. So it gives nonprofits that flexibility to respond to these changing conditions, and then lower any potential barriers that you may have of, easily donating to the organization. So make it as easy as possible on your website for them to see, where can they donate, maybe considering doing monthly donations or some of those that you go for a year-end appeal where you're asking for large donations, say like, we are aware of the times and the economy, maybe you feel more comfortable just doing a monthly donation, and that helps with both your cash flow, and then they're not having to worry about making maybe this huge payment at the end of December and trying to get a check. So using these various avenues to engage with those donors.
Those are all great points, Liz. And I also wanted to add that it's always been important to diversify your funding sources, but especially now, and just taking the time to assess your concentration of revenue. So if a significant portion of your funding comes from one federal department or a single funding source, that creates a lot of risk. And exploring opportunities to broaden your base, whether that's through expanding donors or reaching out to private foundations or corporate sponsorships or partnerships to build a more resilient funding portfolio. That's really key.
Amy, and the points that you just made really hit home for me, because I've recently worked with a nonprofit that was almost exclusively funded by 2 or 3 foundation donors, just large grants coming in, helping them get established and continue their operations. And so what they realize is that relying on those 2-3 foundations is really making them vulnerable in case if the foundations don't extend or renew their grants, or maybe their mission no longer aligns with the foundation's funding priorities. And so they sat down and identified a few ways to diversify their funding sources. They introduced a small fee-for-service program. They applied for a broader range of grants, not just to those 3 go-to funders, but they actually reached out to a few others that they have done some research on, and really worked on building their relationship with a wider donor base, individuals and corporations that may not be as limited by the granting cycles, and would be maybe easier to build relationships in some cases. And so the CFO shared with me that just taking those steps really made them feel like they were more in control of their future. And it looks like, based on the response to the second polling questions, actually most of our listeners are either actively already assessing the impact of the federal actions and forecasting scenarios, or monitoring the developments closely. So great job. So far, we have talked about the operational responses to federal actions. But Amy, how do all of these considerations impact the financial reporting for nonprofits that are governmentally funded?
Yeah, that's a great question, Julia. I think there's several areas that nonprofits really should be monitoring closely. The first being around the collectability of accounts receivable. I talked to one nonprofit earlier this year after the executive orders were first issued, and I remember them being extremely nervous as they hadn't received a payment on a large grant, but they also hadn't received any formal notice. And it turns out, after talking to them, that they actually hadn't reached out to their grant officer directly. And it was just that the office that processed their invoice had changed, and their main point of contact as a result changed. So 2 things to really watch out for are slower payments, and then notices from the funding agencies regarding collectability of receivables. And also, Melanie had previously mentioned the importance of being proactive. So maintaining open and proactive communication channels is really critical, and also understanding your funding agency's budget outlooks as much as possible, and what impact that may have on your awards as a result. And you would also want to consider the need for any potential reserve if there are any concerns. We've also had a lot of questions come up recently regarding liquidity and evaluating cash flows for 12 months from the report date is key. And if significant funding is lost, an organization may need to perform a going concern analysis, which management is actually required to perform on their end. And if substantial doubt exists, an outcome or result of that may be the need to disclose, and the audit report may need to be modified. And then finally, ensure that your board of directors is fully informed. So any financial risks, any cash flow issues, any potential reserves related to government contracts, their oversight is really crucial for navigating these challenges, and they may be able to assist the organization. And I know Liz serves on several boards, and I'd actually love for her to share her perspective on the importance of board engagement overall, especially now.
Yeah, of course. And Amy, I think you said it perfectly, having that open communication with your board, engaging them in the conversation, ensuring they understand what the strategy and the scenario planning mean. If you do have funding stop, how is that going to have an impact? How many families are going to be impacted because of that funding? How many employees potentially may be impacted? So really ensuring that they understand the entire picture, and they're just not thinking dollars, but the true impact to the organization and the individuals that you're serving. And this is a perfect time to really use your board so they could open doors for new funders, new partnerships. They're there for that financial oversight and their fiduciary duty to really support the organization. And so ensuring that you're equipping them with the right information and making the right asks. So if you're giving them maybe a personalized communication that they can then go ahead and make the ask to maybe their corporate or other partners, make it easy for them. So really quantify, the impact of the donation. This funding will help these many families, it will shelter these many animals, or whatever that is. But if they have the right tools and you can make that ask and they could go out there, I think make it as easy as you can for them, and make sure that communication is, both transparent and consistent across the board, also both management, your development team, the board, they all have that consistent message and that consistent ask as well. And then also communicate any successes that you've had. So if you are getting the money to help a program, make sure you acknowledge that. Thank you for this donation. It helped. So, whatever the impact was, I think once you communicate any success, any challenge, it just reinforces accountability among management and the board itself. And lastly, use them to make sure they champion the mission of the organization, make sure they advocate and support any policies that are out there that may impact the organization, may impact the funding, and really use them in that way.
Thank you, Liz. I absolutely agree with you. The board can and should play an important role in advocating for the organization. Just to share one example, one of the nonprofits we work with really took it to heart. They brought in their board early on when the executive orders started coming out, and were able to rally and create some solutions together with their board members. So one of the board members had a close relationship with the foundation, so they tapped into that and were able to negotiate a grant for the nonprofit. Another board member had a banking relationship that helped the nonprofit to get a line of credit. I know Melanie mentioned that may not be the best long-term solution, but it really helped them in the short term between the funding delays, the contract negotiation delays, and some of the delays in collections. So that can really be helpful and important to draw on the resources that your board can provide. So let's switch gears a little bit and talk about operating reserves. Melanie, in an uncertain time like this year, how should nonprofits rethink reserves or plan their cash flow today?
Yeah, thanks, Yulia. Let's talk a little bit about operating reserves and short-term cash management strategies. Operating reserves are, of course, a critical component of financial sustainability. But I think it's important to note it's not one-size-fits-all answer. It really depends on your specific situation. It comes down to the type of organization you have, the size, and really the structure of your nonprofit. But something we have seen at some of our nonprofits, for example, would be that they're maintaining between a 3 to 6 month operating cash flow. And this buffer really allows them to manage through any funding delays, unexpected expenses, or provide or periods of revenue shortfall without having to make any drastic cuts, for example, laying off employees as such, or disrupting the services, no longer being able to provide the service to the participants as they have done previously. And I think also having these reserves is really a key signal to the funders as well as stakeholders for a sound financial stewardship. Amy earlier referenced the timeliness of collections. I think especially in today's climate, I would say this is a key area of nonprofits to focus on and really pay attention to. Are you collecting timely on your grants, on your contracts, as well as your donor pledges? Are you following up proactively, and do you anticipate any delays in payment? I think luckily for us, for the nonprofits that we work with, for the most part, we have not seen any delay in payments compared to previous years. But of course, that doesn't mean that will not happen in the future. Earlier, I also talked about scenario planning and how it should be part of their regular management practice. And I know, Liz, you're part of several boards. And I'm hoping you're having these discussions, right, about scenario planning. Is operating reserves a topic that you're discussing? Could you maybe share a little bit about that?
Yeah, no, definitely. I think it is. I do sit on the board of a nonprofit that is heavily government funded. And so we went ahead and did a scenario planning through our CFO to really understand some of those levers that we would need to pool if the funding was cut off by some of those major contracts. And we worked with the board and management to really model this out, those what-if scenarios that you talked about. And we did look at our cash liquidity as well. And so even though our cash liquidity was very good, it was several months, it was then pointed out, well, it's actually early draws that we're taking for specific programs. So we actually can't use those funds for all of our operations. They're restricted for whatever program we ended up drawing down on. So understanding that even though you have reserves and maybe cash liquidity, you may actually not be able to tap into it because they're restricted for specific programs of the organization. And I think it's important to understand what those restrictions are.
Yeah, thanks. That's actually a good point, right? Liquidity is great to have, but really understanding, are those assets really restricted for a certain purpose or a certain time frame? So thank you for sharing that. Also, another tool I wanted to discuss is dynamic cash flow projections. So this really is a simple but powerful tool to support as a 12-week rolling cash forecast. It's really a short-term forecast which provides visibility into the cash coming in and cash going out over the next 3 months. It's relatively quick to prepare, and because it rolls forwards each week, it also stays relevant and really responsive to the changes in your actual cash positions. And I think this kind of forecast really helps leaders of really any kind of organization, doesn't really matter, right, nonprofit or for-profit, to make timely decisions, whether that in regards to adjusting your expenses, working on speeding up collections, or maybe changing the timing of the funding requests that you're sending out.
And just to echo what you, Melanie and Liz have been saying, just recently, one of the nonprofits we work with shared that they've been really closely watching the changes in the federal actions and potential cuts to Medicaid. So what they've actually done is they are working to create several versions of their annual budget for the next year, one with the status quo, one with the potential estimated funding cuts to federal programs, and another one with potential cuts to Medicaid and how that may impact their programs. And so they've already been doing the 12-week forecast, Melanie, that you mentioned, and now it became even more important to quickly pivot and make changes as they get more and more information. So when we talk about reserves, we usually think about public charities and the 3 to 6 month rule and that Melanie mentioned, but reserves are maybe as important on the private foundation side. Amy, what do you see changing in how our private foundations are approaching the reserve levels and their investment strategies?
Sure. So private foundations should really be considering their own liquidity, not just the liquidity of their grantees during this time. And due to the recent market volatility and resulting impact on investment portfolios, I know several private foundations that we work with have actually revisited their investment policies with their investment advisors and boards to assess if there's any adjustments needed due to changes in risk tolerance due to current events. And Melanie and Liz had previously mentioned the importance of scenario planning and rolling cash flow projections for nonprofits, specifically with government funding. But this is also important for private foundations, even though the process will probably look different. So it's important for private foundations to assess if current liquid investments and cash levels are adequate to cover operational costs and committed grant payouts for at least 1 to 2 years out, assuming investment returns may be flat or even negative. And private foundations also tend to be invested in less liquid investments. So we'd actually recommend doing a robust rolling 12 to 24 month cash flow forecast. And this forecast should include anticipated investment income, planned grant distributions, and operational expenses. And we also recommend not relying on historical averages, but incorporating forward-looking market and economic assumptions, and also considering the potential impacts due to changes in the tax code that Liz referenced earlier in the webinar. And then also consider the timing of new grant commitments. So if investment performance is unfavorable, a foundation might need to more thoughtfully adjust the timing or size of new grant commitments to ensure their own sustainability while honoring existing obligations. And so if that's the case, transparency with grantees is key if such adjustments are necessary. And then I'd say finally, just continuously reviewing operational expenses for any potential efficiencies without compromising core functions, of course, and assessing if anything could be automated. Colin gave some excellent examples earlier on.
Those are great points, Amy. Very helpful for our private foundation listeners. Well, thank you, everyone. And before we conclude this conversation, let's do a quick round around the room on what is one actionable takeaway our nonprofit listeners can apply today. Melanie, we'll start with you.
Thanks, Julia. So I think we shared a lot of great ideas and strategies overall, but I think one that's pretty straightforward, in my opinion, really is to evaluate the liquidity of your assets, as I mentioned earlier. Many nonprofits have sufficient assets, but it's really crucial to consider how quickly those assets can be converted into cash if needed. And then also going back to the point that Liz made, right, in regards, are these assets actually restricted for a certain purpose, or certain time. So if that is the case, again, you can't really use those and wouldn't be really liquid assets. And having assets is one thing, but having access to to turn them into usable cash, right, when it's most important, is another. And actually, just really quickly, also wanted to share, I just recently, yesterday, actually saw that one of the nonprofits I work with, they have a good amount of investments, and they actually started rebalancing their investment portfolio away from alternative assets to more cash and cash equivalent investment types.
Yeah, and then I'll go next. I think the takeaway would be to really rally your board members, utilize them to the full extent. You know, they're there for the organization and you should be using and tapping into them. The second, making sure your website is updated. I recently met with somebody who helps staffs distribute funds, and she mentioned how oftentimes it's very hard to find the EIN of the organization. So making sure it's very visible so they can ensure you're a public charity and do their research and grant out to the organization. You know, they look at Charity Navigator and GuideStar as well. So keeping your profiles updated is also very important now.
And I would say probably utilizing dynamic rather than static budgeting would be the biggest takeaway for me. Just in uncertain times, being able to be nimble and adapt quickly is really important when you get new information.
Agreed. And from my standpoint, I would say it's really important to stay up to date on what's happening with the legislature, with some of the funding updates. So you should determine or identify a champion internally that would do that, that would really stay up to date and read everything that's out there to track what is happening. And of course, utilize your trusted advisors such as GHJ. If you have any questions, if you want to know what's happening, please feel free to reach out as well. Especially, we know that a lot of the nonprofit teams are under-resourced, so we are here for you to help with communicating what's going on. Thank you, Melanie, Amy, and Liz, for sharing your insights and real-life experience with us today. Hopefully, what we shared provides to our listeners something to think about as they navigate the challenges and financial sustainability in the months ahead. We will now launch our third polling question, which is, what area of technology needs the most improvement in your organization? We have just a few minutes to answer a few questions that came in through the Q&A. So the first question that came in, Amy, I'll direct this one to you. What are some key performance indicators nonprofits can use in evaluating sustainability?
So that's a great question. A few KPIs related to sustainability that I would prioritize would be one, months of cash on hand, which Melanie referenced when she was discussing reserves earlier, burn rate, and also revenue diversification, which I referenced earlier on as well. Cash flow accuracy is another one. So comparing projected versus actual cash position on a monthly or quarterly basis, however frequently you'd like. And that indicates how well the organization is forecasting and managing liquidity. Another one I would say is fundraising efficiency. So looking at the ratio of fundraising expenses to total contributions. And then finally, I would say looking at mission return on investment. So this answers the question, are costly programs delivering the greatest impact per dollar? So comparing outputs to costs. An example would be the number of meals served to the cost of the meal. So those are just a few examples of KPIs that nonprofits can utilize.
Thank you, Amy. I really like the mission return on investment one because sometimes we see nonprofits that are really, really diversified in their programs, and they may not realize that some of the programs really are a burden on the overall organization, and doing that analysis may help identify that. Another question that came in, I'll direct this one to Liz. When we talk about reserves or strengthening liquidity, how does all of that show up in the Form 990, which is the public document available to everybody?
Yeah, that's a great question. There is a specific schedule within the Form 990 where nonprofits are required to actually disclose the activity if they have a full endowment, like a permanent endowment, or even a board designated quasi endowment. In that schedule, you have to record, what is the total balance, what were the net earnings, and what were the expenditures during the year. And you're also required to include a description as to what is the purpose for those fundings. So ensuring that you're using that narrative section to really state what you're planning to use those reserves and really be transparent and use that narrative. You're not just holding it to hold it, but it is for that specific purpose for the organization.
Agreed. Melanie, a really quick one for you. Can you confirm if the single audit threshold is based on when the spending takes place or when the federal funds are received?
Great question, huh? No, kidding. So most of the time, federal funds are actually cost reimbursement contracts, right? So it's really dependent on the revenue, depends on the expenses the funds spent. So that's what I would be looking at for that $1 million threshold.
Great. And Colin, one for you as well, the data analytics. Do you have any best practices for data quality and governance?
It's a great question. So, what you really want to do is focus in on a strong data foundation, which begins with good data governance. So, what does that mean? This means setting clear rules and responsibilities for how data is collected, managed, and shared across your organization. So, data governance ensures that everyone knows who owns which data, how it should be used, and that it's accurate, secure, and consistent. It also helps build trust in your data by promoting accountability and transparency. So, with this foundation in place, your organization can start connecting different types of data to see the bigger picture. So, tools like data visualization, business intelligence really help leadership make better decisions and uncover new insights. And over time, this can lead to time savings and cost cutting improvements through automation and smarter processes.
Thank you, Colin. Our time is now up. I'm sorry to say, I really enjoyed spending the hour with you, and thank you for spending your lunch hour with us. A big thank you to our speakers, Liz, Melanie, Amy, and Colin. And for those who raised questions in the Q&A, we'll address them via email. Thank you for joining us today, and enjoy the rest of your afternoon.